everybody, this is Alan Jackson. I want to first welcome you to the channel. Thank you for watching this video, and if you like the video, if you have any feedback, please be sure to comment, like, and subscribe to the video. Now today's topic is going to be the Gordon Growth Formula. The Gordon Growth Formula is basically a dividend discount model that has some usefulness. It's simple, it's elegant, but it also has some shortcomings as well. So when you're using it to value equity securities or stocks or anything like that, you want to be aware of when to use it, when not to use it, what are the benefits and what are the shortcomings of the model. So we're going to go over that. We're going to go over the formula. We're going to go over the inputs to the formula. And then we're also going to discuss when and when not to use the model when you're trying to evaluate stocks in the open market. So first, as I noted earlier, the Gordon Growth model is a dividend discount model that assumes growth into perpetuity of the dividend. It's also assuming that the major cash flow or the value of the security is based primarily on the cash flows you will receive as an investor, which in this case will be the dividend. And so with those two assumptions, you're going to have to make sure you understand exactly how those apply to your valuation, so you can apply it to your analysis the correct way. So, as I said earlier, the dividend is assuming growth into perpetuity. So, if your investment horizon is, let's say 5 to 10 years or 1 to 3 years, if your investment horizon is a little bit more short term as opposed to longer term, this model may or may not be helpful for you. So here is the inputs to the model. It's going to be the current dividend, which we're going to call D0, times 1 plus the growth rate of the dividend, minus your required rate of return R, minus the growth rate. And that's the whole formula. Now, it seems simple, and it is very simple, but the problem are these inputs here. A small change in these inputs will have a huge impact on the value of that you will derive from this model. So, again, assuming that the dividend is growing in perpetuity, your growth rate should be relatively low, right? And it should be at or around the growth rate of nominal GDP. Simply because if you have a growth rate, let's say that's 20%, you're going to have a huge value for the security, but it's not very realistic because you're assuming growing at 20% in perpetuity, which is that's just not likely. It's very unlikely. So your growth rate of the dividend should be around the GDP rate of the country that you're investing in. So if it's in America, this should be around 3, 4, 5, 6% in terms of nominal GDP. And so these two G's are the same. And then your rate of growth is going to be your required return on equity. Now, most people use the capital asset pricing model, and if you're not familiar with that, I'll make another video describing what the capital asset pricing model inputs are, so you can know what this is. But other people just tend to put a required return that they deem, necessary for themselves or for whatever investment they're undertaking. So if this is a very risky venture where there's a possibility of you losing money, your required return might be higher. If it's a very consistent and stable business, your required return would be lower. Which brings us to the application of this formula, in that it's very good for industries that are very consistent, that have a consistent dividend payout ratio, and that are stable. Because it's easy to see and it's easy to predict what those dividends will be in the future. And as I said earlier, this model is assuming growth in perpetuity. So you want something that's consistent and something that's stable, and that tends to pay out a lot of dividends in terms of its payout ratio. companies that don't have dividends, or dividends that are not very stable, or uncertainty surrounding the dividend. It might be in an industry that is undergoing a lot of change. This formula may not be applicable to that company, and if you do apply it, you might get something, or you might get an output that's completely different than what the actual intrinsic value of the stock is. So you just want to be aware of that when you're applying this formula. Finally, probably the most important part of this formula is going to be these two inputs here. A small change in this denominator will have a very, very, very big impact on the output of the value. So you really want to make sure you're conservative with your assumptions. So in terms of what I mean by conservative is assuming even if the historical dividends are increasing by 7, 8, 9, 10% a year, try and see what the value is assuming 5%. See what the value is assuming 4%. A lower growth rate will tend to, all else being equal, will tend to lower this value. So if the stock is still attractive even with the lower value, then that might mean you're onto something. You might have identified an undervalued stock that's showing promise for capital appreciation. Also, with your required rate of return, make sure you're conservative there as well, because you do not want to have a very high value when it's not justified by the facts. So just be careful of your inputs. The best way to do this is just to go into Excel and just perform a sensitivity analysis, and and see what the value is with various required rates of return versus required growth rates. And so once you have that assessment, once you do your sensitivity analysis, you can see where the stock price is in the market versus what your assessment of value is. And that will allow you to make a better determination on whether to buy or whether to sell the stock. And so that's it. So that is the Gordon Growth Model. If you have any questions or if anything was not clear, please just let me know, and I'll try to clarify it in an upcoming video, or just send you a quick email. So this is Alan Jackson. Thank you. Have a nice day.